Welcome everybody to the 40 Finance channel, making my triumphant return here after taking just a few weeks off of the stock market to work on some other things, get some family stuff in order. And the bottom line is I feel like I missed very, very little. And that's what is interesting because in that time, particularly this week, we've kicked off the earnings season. We had the almighty Fed come out and make their declarations. So what I'm going to do today is just share 5 observations, at least from my perspective, on where I see things in the stock market right now. As always, while we're going through this video, we'll be using the Seeking Alpha stock platform. If you're interested in learning more about this awesome tool, my affiliate link is in the description. Gets you 1 full year, 12 months for only $99, and it does include a 7-day free trial on the front end before you're even charged. So definitely check that out, potentially support my channel as well. Okay, so 5 quick observations on the stock market. One thing that certainly hasn't changed is we are still biting our nails around every movement that the Fed makes. And I don't know about you, but at this point, it's just exhausting, right? I can't even listen to the CNBCs of the world right now because they're just so enamored on what certain sentences mean. We can't even enjoy the results of this past meeting that happened yesterday, or at least the notes in the press conference, without immediately turning our dials to the next meeting coming up and what it might mean. At this point, I think, at least for myself, I'm taking the perspective that the end is near. There may not be a pivot. There may be a pivot. I don't know. But at the end of the day, the interest rate hikes at this point are becoming unsustainable, right? So I'm penciling in that we are all done with interest rate hikes. And frankly, I don't even care to talk about it anymore because I think we have to turn our focus into what companies are doing at this point. The inflation and the fears of recession, that world has been baked in now 6 to 8 months. So I know that there's obviously fears of the future. There's always going to be fears of the future, right? But let's take the data that we have today, specifically from companies, because we're in the stock market. We're not in the Fed market. We're in the stock market. So let's talk about earnings and revenues for the companies that we own in our portfolio, and let's just focus on that. For long-term investors, I think it's the best way to go. Now, my next thoughts in terms of my portfolio and the stocks that I follow on this channel revolve a lot around the QQQ. Now, when I look at the QQQ, particularly if we scroll out, this is a 10-year chart that's on the screen right now, I see the buildings of a slow and steady positive year. Here, and you draw an imaginary line or of trajectory that you might see, I would say, quite honestly, that we're still on pace from the 10-year view. And then if you break it down into the 5-year view, here's your pre-COVID highs, and you kind of connect the dots here, it's not that different of a trajectory than what you saw the couple years before COVID. Now, to be fair, this is high-level chart analysis, and it's not really something I ever even do on this channel because I'm much more focused on earnings per share and revenue growth. But that's just a casual observation. But if you're just to ask my opinion, looking at this, if I had no other information available about the past or the future, I would say that these lines from here to here connect pretty well in the general flow of where things have been going for the QQQ. So that doesn't mean I'm overly bullish, but I'm certainly not overly bearish either. And at this point, I would say that the case for slow and steady earnings or slow and steady price appreciation for the QQQ, it's still very well intact. All right, and some of my opinions from point number 2 of slow and steady gains is fed by point number 3, which is fundamentally earnings have been good, particularly in the QQQ. Okay, so right here on Seeking Alpha, I just did an earnings recap. So I created this portfolio. It's just simple 1 share of each stock, and it's based on the top 50% weighting of the QQQ, all the names that are in that. And if we just sort by most recent earnings announcements, and we kind of eyeball down here, right? We're looking for green instead of red. We're looking for actuals that were higher than the estimates. And this surprise column tells you by how much. Then you go over here to the revenue side, and here you have actuals that were reported versus how above or below the consensus estimate rolling into it. And it doesn't take a genius to see, even with things like AMD, which people were very spooked about their outlook for the future, which is fine. But from an EPS line, they beat by 4 cents. Okay, it's not a lot, but it is something. Then on the revenue line, basically came in flat. And then you look at, let's take a negative. This is T-Mobile. Okay, T-Mobile EPS up above estimate. Revenue, yes, it fell short. $200 billion on $20 billion. So it's not like this was a huge miss by any stretch of the imagination. We like to build up misses in the media and spook the markets. But everything else here, you go to Tesla missed slightly on revenue. Again, $26 million. Good news, they brought in $23 billion. So, there's some positives there, and EPS was flat to consensus. So I'm seeing a lot of green, particularly if we start talking EPS, okay? And I know that when you're in stocks like the ones in the QQQ, revenue is important, growth is important. But fundamentally, for long-term investors, hitting your EPS numbers and continuing to project EPS growth is what gives you that fundamental foundation that lowers the forward PE. All right, next up, from at least my perspective and the QQQ, this volume, the average daily trading volume, there's nothing really here. I wouldn't call it the lowest volume of all time, but it's just like a meh number, okay? You've got 59 million shares yesterday. It doesn't take you very long to scroll down here. If you go back to April 24th of 44 million, okay, you've got a 38 on April 19th. And if I scroll all the way down this thing, because it's a 12-month chart or tabulation, we go to May 4th of last year, you're at 116 million shares being traded. Now, last year was much more volatile, right? So that had a lot to do with it. You had a lot more activity as people were trying to adjust to what the Fed was doing. But keep in mind here that May 4th through 12th of last year, it wasn't like the Fed started on that day. They kind of came out and made their first proclamations in February of 2022. So, bottom line for me, when I just look at these volume numbers, and I think it's safe to say that we can expect these volume numbers to go down even more in the summer, as a lot of people take summers off. The old adage of sell in May, walk away. You do see a lot of that in summer. So if we're only in the 40s, 50s right now on the Qs, we could see a lot more 30 million volume type days in the dog days of summer if things keep slogging along. And that to me is even better news for the concept of slow and steady price appreciation. All right, wrapping up here with observation number 5, at least from my perspective, is at the end of the day, DCA wins again. So dollar cost averaging is the way to go. I think everybody who's long-term investor already knew this. If you're like me, you made some mistakes with this during the stock market run-up in terms of shiny objects and stuff like that. But when it comes to the Qs and the companies with inside them, I still think you have a lot of opportunity in this environment to DCA with the QQQ. I'm doing one share sporadically here and there, a few shares of TQQQ for the long term. That's a whole nother case study. But the bottom line for me is I feel confident, not necessarily that I'm going to go up 20% from here, but that in 3 to 5 years buying now, the price will be cheaper today than it will be tomorrow. And if you think of all the distress we went through over the past 12 months, and here's a 1-year chart you're down 4%. If you bought on May 4th of 2022, you bought one share, and you watch the market go up and you watch the market go down, you watch the Fed come out, you watch the Fed go away, you listen to people talk about oil prices, gas stocks, financial stocks, all the things that were going on. You woke up today on May 4th, 2023, you would have lost a whopping 4% from buying last year at this time. And during that time, you would have had some peaks and valleys, but for the most part, if you would have, say, bought one share each month for the past 12 months, and I can't see exactly where those points would be on this chart, but suffice to say, you would have picked up 3 or 4 or 5 shares in this stretch from, call it October through February, so maybe 4 shares that you would have picked up, and those would all be positive. Today, your cost basis would be down significantly, and you would be looking at a positive portfolio just from dollar cost averaging during one of the wildest times that you'll see in an economy on the way things change with inflation, interest rates, whatever. So bottom line, no matter what you're investing in, whether it's the SPY or the Qs, or you have particular individual stocks you're looking for, I still think that this is a good environment to DCA with the companies that you have the most conviction for. On my side, that's the QQQ. All right, before you go, don't forget to check out that Seeking Alpha special offer down there in the description. Hope everybody's doing well. We'll see you on the next video.